The stock market can be a wild ride, soaring one day and plunging the next. But when a crash strikes, should you panic and sell everything, or stay the course and trust your strategy? In this video, we're cutting through the noise to uncover the truth about market crashes. Are they a sign to get out, or a hidden opportunity to stay invested and come out stronger? Let's find out. Today we will talk about the truth about stock market crashes. Should you panic or stay invested? So before we start, make sure to hit the like button and subscribe to my channel. 1. Why market crashes strike fear into all investors. Stock market crashes are a dramatic and often alarming phenomenon. A moment when prices spiral downward in a matter of days or even hours, wiping away vast amounts of wealth. Naturally, when portfolios diminish by 20% or 30% in a short period, it sparks panic and a rush to sell in order to cut losses. But this fear, while entirely human, can be dangerous to your financial future. Market crashes have occurred numerous times in history, from the Great Crash of 1929 to Black Monday in 1987, the dot-com crash in 2000, the global financial crisis in 2008, and more recently the COVID-19 shock in March 2020. Each episode seemed catastrophic in the moment. Many believed the markets might collapse altogether. Nevertheless, after each downturn, the market recovered and went on to reach new heights. So the key question for investors today is, when chaos strikes, should you panic and withdraw, or stay invested and wait it out? 2. What actually happens during a market crash? A market crash typically occurs after a period of sustained optimism and overvaluation, when prices become disconnected from fundamentals and sentiment, reaches irrational exuberance. It may be triggered by an external shock, a geopolitical crisis, a dramatic policy change, a collapse of a large financial institution, or a health crisis like COVID-19. Whatever the cause, fear quickly overtakes confidence, and selling cascades into a massive downturn. Large investors, hedge funds, and algorithmic traders respond by liquidating holdings, adding to downward momentum. At the same time, margin calls force many traders to sell their positions to pay back borrowed funds. The result is a dramatic drop in prices across the board, stocks, sectors, and sometimes even defensive assets, regardless of their actual financial health. Importantly, this drop typically has less to do with companies' true value and more to do with liquidity pressures and herd psychology. 3. Historical market crash examples provide valuable lessons. Looking back at historical crashes, we find a consistent pattern: panic selling dominance in the short term. But the market eventually finds a bottom and recovers. The 1929 crash, which fell nearly 90% from its peak, seemed permanent at the time. Yet within years, the market rebounded and went on to grow over subsequent decades. Black Monday in 1987 saw the Dow drop more than 20% in a single day, prompting worries about a repeat of 1929. Instead, markets recovered within a few years. The dot-com crash of 2000 to 2002 was a painful downturn, particularly for technology stocks. But even then, the broader market recovered by the mid-2000s. The 2008 financial crisis was a dramatic collapse stemming from the subprime mortgage market. It took nearly 5 years for the S&P 500 to return to its previous high. But it did, and then kept soaring. The COVID-19 shock of March 2020 was the fastest drop into a bear market in history, falling more than 30% in a matter of weeks. Yet it rebounded just as quickly and made new all-time highs by late summer. 4. Why staying invested wins in the long run. This pattern underscores a key principle for long-term investors. Staying the course typically results in recovery and eventual profits. Market drops, however dramatic, are a normal part of investing. There has been a correction of 10%, or more nearly every 1 to 2 years in a bear market, 20% drop about once a decade. Importantly, over long periods, 20, 30, or 40 years, the stock market has a powerful upward bias. The S&P 500, for example, has historically delivered an average annual return of about 10%. That means, despite numerous downturns, an investor who remained fully invested from 1980 to 2020 saw their portfolio grow nearly 30-fold, ignoring dividends. Furthermore, trying to time the market, selling when you fear further drops, and buying back in once you think it's safe, typically results in underperformance. There are numerous studies showing that missing just the 10 best days in a 20 or 30-year period can cut your portfolio's return nearly in half. Staying invested lets you capture all the eventual recovery and subsequent growth. 5. Why panicking often leads to poor decisions. The human tendency during a downturn is to cut losses and withdraw, thinking it's the safest course. However, this reaction, while emotionally satisfying in the moment, typically converts a temporary downturn into permanent losses. Selling locks in losses and destroys future earning potential. You miss the eventual recovery in future rallies. Furthermore, attempting to time your re-entry, I'll buy back in when the market starts going up again, is nearly impossible to do accurately. Market bottoms are only clear in retrospect, and rallies often start when sentiment is at its worst. The result is a pattern of buying back in at higher prices, having missed the recovery, which erodes total returns. Furthermore, frequent selling and buying can incur additional expenses, taxes, and undermine the power of compounding. Staying put lets you avoid these pitfalls and benefit from the eventual recovery, regardless of how dramatic the drop seemed at the moment. 6. Prepare, diversify, and keep emotions in check. The key to staying invested during a downturn lies in preparation and discipline. Before a crisis strikes, it's crucial to have a well-diversified portfolio that comprises different asset classes, stocks, bonds, cash, and alternative assets, to help absorb market shocks. Diversification smooths returns and dampens volatility, reducing the likelihood that you will panic in a downturn. Additionally, having an appropriate asset allocation, reflecting your risk tolerance, financial goals, and time horizon, lets you stay the course even when markets fluctuate. Setting aside a cash reserve or rainy day fund can help you avoid having to sell at a loss to meet expenses during a downturn. Furthermore, employing strategies like dollar cost averaging, regularly investing a fixed amount regardless of market conditions, can allow you to buy more when prices are low and less when prices are high, reducing your average cost basis. Importantly, staying informed, focusing on long-term goals, and ignoring short-term noise can help control emotions and avoid impulsive decisions. 7. When it may be rational to sell, but be careful. While staying invested is typically the best course of action for long-term investors, there are a few scenarios where selling might be reasonable. If your financial goals, risk tolerance, or time horizon has changed, for example, you're nearing retirement and need to reduce risk, then reallocating assets may be appropriate. Furthermore, if a particular investment no longer aligns with your portfolio criteria, say a company's fundamentals deteriorate due to poor management or permanent industry upheaval, selling that stock might be reasonable, regardless of the market's movements. Importantly, these decisions should be made based on careful analysis and a well-thought-out plan, not pure panic or fear. The key is distinguishing between temporary downturns, which markets typically rebound from, and permanent damage to a business' future prospects. An objective, disciplined approach is far more reliable than reacting emotionally to short-term fluctuations. 8. Staying calm during market turmoil. Ultimately, whether you panic or stay invested during a market crash comes down to your discipline, patience, and understanding of market cycles. Market downturns are not abnormalities. They are a normal part of the investing journey. Fear and pessimism may seem overwhelming in the moment, but recovery and growth nearly always follow. Staying invested lets you benefit from this upward trajectory over time. That's not to say you should ignore risk. Diversification, proper asset allocation, and having a clear financial plan all help you navigate volatility with confidence. But by staying calm and ignoring the herd's irrational panic selling, you avoid turning temporary losses into permanent ones and allow compounding to do its powerful work. So when the next downturn inevitably comes, and it will, remember, this too shall pass. Your patience and discipline will be rewarded in the long run. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.